Hi, everybody. Jeff Yastine here. Welcome to another edition of Market Insight. I'm joined, as always, by my friend and colleague and editor of Automatic Fortunes, Ian King. So, Ian, welcome.
Hey, Jeff. How's it going this week?
It's going well, and it appears that the market is going well, too. And I was curious about all that, especially considering a lot of the civil unrest that we're seeing related to the situation in Minneapolis all around the country here. And I was curious what the market would be like, Sunday night when the futures opened, and of course today and on through the rest of the week, whether the market might be down a bit just in terms of uncertainty regarding this whole situation. So far, the market appears to be, just discounting it entirely for now. I'm curious what your take is on it.
Yeah, I mean, it just seems like this unstoppable market just continues to, head north. The futures were down a little bit last night when they opened. I think they're down about 20, 25 points or so, and they rallied throughout the night. And as the stocks opened this morning, we're up a little higher. But, it's just one thing after another. The market continues to discount. We've got 30-odd million people unemployed. We're heading towards the largest fiscal deficit in decades. The debt situation, we're going to have U.S. debt to GDP over 100% this year. Things are getting better, believe it or not. I mean, we're starting to reopen some parts of the country. And if one thing that you could take from all the protests and demonstrations on the street, people aren't worried about coronavirus anymore, that's for sure. So, I mean, maybe the market's finally seeing that this spread hasn't been as bad as the expectations were a couple months ago. What do you think?
So, well, I think, as you were saying, the narrative for Wall Street, the folks who kind of set the pace in terms of prices going up or down, the narrative here remains the reopening of the economy. And as you were just saying, the economic news is bad, and it will continue to be bad for quite a while. But the market and the investors are looking beyond that. And I think another thing they are looking at is, I think there's what Mitch McConnell in the Senate has said is a fourth and final stimulus package, which I think they plan to bring out in about a month or so. And so, I can't help but see occasionally when the market appears to run out of steam. I saw this last week. Various commentators will say, the market needs another shot in the arm. And so far, every step along the way, we've had either the Fed or this trio of huge, gigantic, never before seen size stimulus programs coming out of Congress. And I think that narrative is just going to continue to play out here, which is why I know you've said it and I've said it as well in terms of buying stocks. Yes, you want to buy stocks smartly. You don't want to buy really overvalued, super overvalued stocks here. But there are plenty of stocks still that have not necessarily participated all that much in the rally here. I know you kind of share a similar view on this.
Yeah, I mean, to your point as well, you're looking at the SPY index and the NASDAQ. There's been a lot of sector rotation going on in the last week. So last week we saw weakness in the big techs that have led the first start of the rally, the Amazons, the Apples, the Microsofts of the world. And we started to see the airlines come back. I think Carnival Cruise Lines was up 15% or so last week. So you're starting to see this rotation. And the reason is that things are starting to reopen. So now people are realizing, look, there's some of these beaten down stocks that you've been talking about. And I know you have some of these in your portfolio, that it might not be that bad if we can actually get the economy reopened to some extent this summer. And I think the market's starting to discount that. So you have traders that are moving from these high-flying tech stocks back into kind of the old world economy names, let's say, and you're seeing rotation. And because of that, you would think that once they're selling the tech stocks, the S&P would drop, but there's enough buying momentum in these other stocks to hold it up. And so you don't see a drop in the indexes. The market just continues to go higher with a change in leadership.
The rotation, like you said, is a very, very important point because, as you said, techs, they've started to weaken up a bit. I know that's a source of concern for some people, but there are so many other sectors, transportation, think about Boeing, and in the energy markets, think about stocks like Exxon and others that have been beaten down so much, and those sectors have taken such a brutal punishment that as it's easy enough for things to rotate, for fund managers to rotate into these other positions, and that continues to elevate the indexes. Any last thoughts here? Because we saw like last week some milestones, not good ones, for things like the supply managers index and those sorts of things, which continue to sort of be those markers of the unpleasantness of February and March, if I can put it that way.
Yeah, one interesting economic indicator that came out last week is the personal savings rate came in above 13%. And this is the first time, it's a huge jump. So it's the highest reading we've had, I think, since the late 1970s. And one of the reasons for it is people obviously are saving more than they have in the past. It could be they're worried about the future, they're cutting down on consumption. But I think the number is kind of skewed because you have to look at how much stimulus checks went out over the last couple months and then weigh that against where people can actually spend that money. So if you had all these businesses closed, you really had no option to spend the money that you were getting. And I think it was Morgan Stanley came out with a really interesting anecdote a couple of weeks ago that we brought up in Market Insights, is that labor income actually is going to be higher if you add in all the stimulus for this quarter,
yes,
which means that people are actually getting more in some cases on unemployment than they were making in their job before, businesses shut down. So you have to give the Fed and the government credit right now for actually taking the right steps that were necessary to kind of put this economy in a little bit of a medically induced coma, let's say, to hold us over until things can reopen. So many people doubted that this could happen. People were saying we're heading towards another Great Depression. And really, the path of least resistance, the road less followed, was to say, no, the government stuff actually could work for once. And if you had followed that line of thinking, you wouldn't have sold your stocks and you'd be right back almost at new highs here in the indexes. And I just have to give a credit to Jerome Powell and to also our government for actually taking the right steps that were necessary, even though they just look so unpopular at the time. $2.3 trillion here and the Fed doing $4 trillion now. But we've gotten to this point and we've avoided the total collapse. I'm curious to hear your thoughts on that. What do you think about?
No, I agree with you. And I think the key, what you were just saying as you started your comment, you're talking about the savings rate hitting, what was the number, 15%?
13.1%.
13.1%. Obviously, people at various moments, like we've seen in the recent months, very concerned about their financial futures. So they're saving more and spending less. And there just weren't many places to spend, as you were also saying earlier. As people relax, as the economy reopens, some of that money is going to come out of the savings accounts or checking accounts and go back into the economy as well. And again, whether it's somebody spending their stimulus check instead of saving it because now they've got their job back, those sorts of things I think will also continue to soften the blow that the coronavirus has hit the U.S. economy, and that those impacts will continue to be ones that will echo through the economy. The savings rates, the stimulus, et cetera, will be something that will continue to help cushion it. So, Ian, I was curious if you have any final thoughts.
One more thing. We've got a huge jobs number coming out Friday. It's the monthly look at the unemployment situation. Expectations are for about a 19% unemployment rate. Remember, we were at 3% just a couple months ago. If this number comes in less than expected, I think the market is really going to put the turbo engines on because, now your fears of widespread unemployment won't be as bad. If it comes in over 20%, I would be concerned. Another indicator that my subscribers and I have been looking at is more so restaurant reservations, because these are more forward-looking alternative data sets. If you're looking at unemployment or claims, you're looking at things that happened last month. What I want to see right now is the economy picking up? We have mobile traffic data to show whether or not people are moving around right now, which is a great data set. And then the other thing, obviously, is you can look at Yelp or Open Door to see if people are actually making reservations at restaurants to go out and to spend money back in this economy and get it kickstarted again. So those are just some things you want to watch out for to stay ahead of the curve and stay ahead of the rest of the pack of investors.
And the idea with restaurant spending is that's discretionary money. So people are able to want to spend more on their restaurant bills. It means that they're more relaxed, and chances are they're also going to spend on other things that they don't necessarily need, but they want. They want things to get back to normal. That's what you're saying.
Yeah, I mean, you saw restaurant reservations drop 99% in the last couple of months because every restaurant was shut down. Now that they're open, I want to see things get back to at least half or 75% of where they were in reservations and bookings to see that people are actually going back out and spending money into the economy so we can start this virtuous cycle all over again.
Absolutely. That's something I'll be looking forward to. So, Ian, thank you. Thank you for coming back on again.
Thanks, Jeff. Always great to see you.
And for all of you, make sure to subscribe to our YouTube channel if you haven't already, and continue to look for our material, and also leave some comments below. I'd love to read more about them. So, Jeff Yastine, wishing you the best of advice, and we'll talk to you next week.